Hi there, and thanks for joining me on this short video that's designed to help you think more clearly about your investments during times of uncertainty, particularly during this COVID-19 pandemic. When we build our financial plans and our investment strategies, we're in a very logical space. We think about it and we look at the returns that are available from cash and the returns that are available from the share market, shown here in orange. We're very clear that we're going to get a higher expected return from shares than we are from cash. We also look at our goals and our dreams and we think, what return is required to fund the life that I really want? And we quickly conclude that the share market needs to be part of our long-term game plan. We set our plan, we invest our money, and we embark on our investment journey. Every now and then, though, an event comes along that really rattles our confidence. It might be the global financial crisis or this current COVID-19. And we're thinking, should I be in the share market at all? Perhaps I should just jump out and come back when the coast is clear. This is what's happened in the Australian share market since the 1st of January this year. Between the 1st and the 20th, the market's bubbled along quite nicely and gained about 7%. Then from the 21st to about the end of March, they dropped quite significantly, by about 30% from the peak, and in the 2 weeks since, they've bounced back. Most importantly, it's been a very, very volatile ride, with significant swings day to day in the value of our shares. It's certainly been enough to make the news and be in the newspapers most days. Here's the thing though, if you get scared during a market downturn, you'll join the herd. And what this slide shows is in the yellow, during the global financial crisis, the markets getting scarier and scarier until they reached the bottom on the 3rd of March, about the 3rd of March in 2009. At the same time, up the top in the black, you can see the number of people switching out of growth options in Australian super. So as the markets got scarier, more and more people jumped out of the market, which is in fact the exact opposite of what a disciplined investor should be doing. What they're doing is buying while things are good and they're feeling confident, and selling when they're fearful. If they do that enough times, they end up broke. Here's the problem with trying to jump out of the market and stay on the sidelines until the coast is clear. This is a graph of the share market during the global financial crisis, and as you can see, between July 2007 and March 2009, markets dropped significantly, with the benefit of hindsight that there's at least 6 opportunities to have jumped back into the market. All of them looked pretty attractive at the time. The first 3 would have been devastating, the next 2 wouldn't have been too bad, but the one that the smart investor had to pick the bottom of the market was in March 2009. Now, what are the chances that a fearful investor sitting on the sidelines is all of a sudden going to become confident and positive just when the markets are at their most scary? Well, of course, it never happens. And what happens is that fearful investor stays on the sidelines until the markets have largely recovered. Because this is what happened in the global financial crisis. From March 2009 through to early December 2009, the markets rallied by 67%. So anyone who was sitting out of the markets missed out on most of that rally. If you're going to be a share market investor, this is a really important slide. If you want the benefit of a higher expected return from shares, which is the long-term reality, you have to be willing to put up with some short-term mess. Here's the result over the long term. This is back to 2002. It's a simple portfolio, 50% shares, 50% cash. As you can see, $100,000 invested back in 2002 ends up being $291,000 for the balanced investor, but it's a bumpy ride compared with $197,000 for the cash investor. I know which I would prefer. As we wrap this up, there are 5 things I want to leave you with. The first is that it's human to feel anxious. These are uncharted waters and we're all in it together. The second is that markets are responding largely as we'd expect, given the level of uncertainty we're going through. The third is that you have a financial plan And that financial plan has been built to factor in uncertainty just like this. You can afford to stick to that plan. The final one is this is a health emergency with economic impacts. It is not an economic emergency. This is a supply side recession that we're going to have, not a demand side recession, because there are plenty of people out there willing to consume. The problem is they've been sent home and told to self-isolate. My final point is that we are here at Capital Partners are here to support you through this. If you have any concerns at all, please make sure you give us a call. Thanks for joining me.